Canada's reached the housing cycle where everyone agrees that affordability is broken, but nobody wants to admit what fixing it requires. Prices have to adjust, sellers have to take losses, developers, which has been a big topic, may have to mark down inventory. Banks may have to recognize weaker collateral, and politicians have to choose whether they want lower prices or whether they want to protect the people who already own the problem.
Yeah, I mean, that's what the episode is about today. RBC, Canada's biggest and wealthiest bank, says that Canadians have basically given up on finding a perfect time to buy. And good, because there is not a perfect time to buy. Tenants say Ontario homes bought near the peak are now selling at losses, in some cases crazy losses, and we haven't seen this kind of scale before. OSFI lowered the domestic stability buffer for the big banks. That's not great. Canada just posted its third straight quarter of population decline. And in British Columbia, politicians are now fighting over whether buying a vacant condo is affordability policy or a developer bailout. Boom, we got a lot to talk about today, Dan.
So the theme's pretty simple. Canada is finally getting the price discovery that we asked for, and now everybody is trying to decide whether or not we actually want it. Be careful what you wish for, I suppose.
Yeah.
So welcome back to the Canadian Real Estate Investor Podcast. This is a news episode. We haven't done one in a while. I feel like we've done more deeper dives on some specific news and our perspectives on it. I mean, especially the bailout thing. But the whole thing is really one story, which is who is going to eat the losses that we're seeing in the market right now. So RBC's homeownership poll showed that 64% of Canadians believe you can never really know when the perfect time is to buy a home. Another poll from, I think it was Nanos, that was in Bloomberg, showed that what were you going to say?
I was just wait. So there's 36% of the population of Canadians that knows exactly when to
They're
buy.
going to time the bottom end perfectly.
Please.
That's all the guys in our YouTube and Twitter comments that are like, yeah, but once prices are down 75% in 2035 is exactly when I'm going to buy.
Man, that is actually I find that really hilarious, to be honest. Only
the rocket
64%
scientists
of Canadians. Yeah. Well, I didn't know we had so many incredible real estate investors that can see the future in this country here. Amazing.
Yeah. And among people planning to buy in the next 2 years, 45% say that now is the right time. So, I mean,
well, there you go. Okay.
There you go. I mean, it is funny. Everybody has their own market thesis. And apparently, it's funny, this stuff matters, apparently. The other one was the majority of Canadians want to see house prices fall, which is interesting. And all of this tells you that the market psychology, buyer psychology, you talk a lot about consumer sentiment. All of that has changed pretty massively. People aren't necessarily optimistic, and it makes you think, be greedy when others are fearful, be fearful when others are greedy. But, your consumers are being very tactical.
For sure. And I mean, look, this is evident, Dan, in our kind of our version of the fear and greed index that we built over at Build Financial, part of our newsletter there, where we basically AI coded, pulling well
it's
over
called
50
vibe coding,
sources.
Nick.
Sorry. Yeah. I tried to sound more professional there, but it really is just vibe coding.
You're I use a research grade personal intelligence platform that got me to that's how I know when the market's actually going to bottom and there is a perfect time to buy.
I mean, look, there must be a lot of people out there doing that same thing. The 36% of Canadians know when, but yeah, I mean, look, the sentiment, essentially the sentiment reader that we built out takes everything from Equifax reports to sales to listings ratio, all that kind of stuff, over 50 sources, and compiles that sentiment meter. And guess what, Dan? Sentiment has not been good for a long time. But at the same time as that's all happening, the Terranet's Ontario Land Registry data shows what price discovery actually looks like on the seller side. Now, back in 2025, over 36% of Ontario properties purchased in 2022 and then resold in 2025, held for 3 years, sold at a loss. Power of sale transfers rose over 2,000 in 2024 to almost 3,000 in 2025. I mean, those are numbers that are not going the right way.
Yeah. This is just Ontario too for Terranet. So we obviously are covering more Canada-wide stuff. But I always think, we've said so goes Ontario, or as goes Ontario, so goes the rest of the country. And it does seem like it's kind of happening that way. Recession, unemployment, et cetera. As much as it sucks, it's a lot of pressure being the center of the universe in Toronto,
Yeah. Totally. But look, I mean, this doesn't mean that the whole market is on fire here. It means that the stress is concentrated around those peak cycle buyers, forced sellers, weak condo inventory, and just bad investments overall. People that paid way too much, people that bought properties they shouldn't have. That's where the real cracks are forming.
And OSFI is paying a lot of attention to this as well, which we've, mentioned, I think, in the bailout analysis episode, not to call it a bailout, but I think we analyzed whether or not what it would look like if it was, what it would look like if it wasn't. OSFI also changed their domestic stability buffer, and they put in a really interesting decision summary note where they're paying a lot of stuff, paying attention to a lot of different stuff, but they changed it from 3.5% to 3% of risk-weighted assets for Canada's biggest banks. It doesn't mean the banks are weak, because the banks are at like 11 on average on I think it's capital adequacy requirements or whatever their domestic stability buffer is. So they could go down to 3%. OSFI basically says average CET ratios have been above 13.5% in recent quarters. But it does mean the regulator is giving banks more room to either absorb losses, which is kind of what the critical bear take would say, or support or stimulate the economy by making more mortgage debt and any kind of business growth debt, while the old risks roll through the economy. And so there's a bear and a bull way of looking at it, which we're going to explore both.
Interesting. Is that, now forgive me, I'm not familiar with the domestic stability buffer. Would that kind of be like the Moody's or Standards and Poor rating
No, it's basically
bodies?
no, it's basically like a ratio at which they feel the banks need to hold this much cash on their reserves
Right.
to
Okay.
keep the domestic financial system stable without, creating too much systemic risk. And
Yeah.
they're 3 or 4x what the required number is already. So they've given them way more room to compress how much cash they have if they need to. And again, they could do that by lending more money out, which I think we could use in a recovery, or they could do it by taking more losses onto their books through bad mortgages, et cetera. If, maybe they're signaling, hey, it's time to clear out all this bad inventory. Anybody who's not paying their mortgage, stop being so nice to them and letting them not pay for, 2 years. Let's get this stuff moved through the market and move on.
Yeah.
So it could
Kinda
be
just
both.
yeah.
Expedite the
It's just
down, expedite the way up.
exactly. I was going to say, experience the reality, experience the pain of it. Look,
Well,
and
it's
population.
necessary, man. That's how it's funny. Like, you hear gurus, it's like, oh, make mistakes, or like smart business people, not even just gurus, like make so many mistakes and learn from them as soon as possible. It's like, well, we have to do that as an economy too. This is how we grow as
Yeah.
individuals, as a species, collectively. So, yeah, I think we gotta get on with it. Stop trying to kick the can down the road. It doesn't seem to be working.
I completely agree. And look, I mean, population plays another key role in this, as it does in the economy and real estate. And, we've talked about population so much on this show over the last couple of years. We've been primarily talking about it growing and then stopping, but now it is on a downward trend, and the population fell again in Q1 of this year, the third consecutive quarter of decline. For a decade, population growth was the simple, clear, and easy bull case for Canadian real estate and just Canada in general, right? More people, not enough homes, rents were rising equals rising prices. But now that that's not happening anymore, investors have to ask, what happens when that tailwind slows or stops or even reverses in markets where, that were at one point priced for endless growth?
This is the challenge. If you were comfortable using it as a bull case, then you have to be comfortable also admitting that it can be a bear case. And so I think the people who are using interest rates and population growth and slow supply as the bull case are now having a very difficult time having to look in the mirror and say, well, supply is going crazy, right? We're building record levels of purpose-built rental. We have all of these condo flooding the market. From the bull run that are coming to completion. You have population falling, and interest rates are too high, obviously, for the average purchaser. So all of the bull cases that the real estate industry used before are becoming, if you inverse them, they should, by following that logic, be bear case. I think, right? I don't know. What's the bull case now?
Is that how we should get Kramer on the show, see how the inverse
Yeah.
works? Yeah, I mean, I don't know. Let's get into it. Okay. So let's talk about how buyers are either waiting or not waiting for the perfect time, because apparently some people know when that is. RBC, the poll is a good snapshot of buyer psychology, which Dan, you alluded to, is a big controller of where the market's headed. RBC did ask Canadians about the perfect time to buy. And again, 64% said you can never really know. And I would agree. I would be part of that 64%.
I think that it's actually nice to hear that the average Canadian home buyer is accepting that they cannot time the market, or like, I think that that's a healthy market signal. And it's a very small headline, and it didn't get a ton of attention, their report, but for years, buyers were waiting for an obvious signal. Okay, I think prices are at the bottom. I think rates are going to be, down. They're down as far as they're going to go. Prices are down. Inventory's up. Whatever. Confidence is back. Unemployment's not falling. Whatever. There's 50 million variables you could throw in there. Population's going back up. All the stuff we just mentioned. And I think people have sort of capitulated and realized that, there's all of these variables are way too volatile, and the right time to buy a property is actually when I find the right property. And,
What a thought.
it's crazy, right? Like, it's like, I get trying to time the market and create a good entry point when you're trading on stocks and macro and prices and the large houses aren't like that. Your switching costs on the way in are 10%. For you to, like, you're paying 5% to a realtor, you got to pay 5% to a realtor to exit, you got to pay land transfer tax, you got to pay mortgage penalties, whatever. Like, it's not a $9 or now $0 trading of a stock. These are complex, illiquid transactions. They require debt. You can't think about them with market timing principles. The best time to do a good deal is always, or whenever you find it. What is it? It's always a good time to do a good deal. It's always a bad time to do a bad deal. That's a very simple rule.
Yeah. I feel like that we should put that on a shirt, man. That must have been said on the show hundreds of times at this point, because it is the truest and easiest thing that is true regardless of the market. You're in real estate. But look, the markets don't give you that all the time, right? When everything feels safe, it's probably too late. And RBC had that contradiction actually baked into this. Most Canadians say timing is impossible. But among the people planning to buy in the next 2 years, 45% say now is the right time. Well, that's interesting. So,
the people who are buying have a bias towards their decision-making behavior?
Crazy, right?
Weird.
You can't time this. Well, active buyers are saying, hey, this is the window. Yeah. Or,
nobody else can time it, but I can.
Yeah.
Makes sense. I mean, but this is how a market reset should feel. Like, this is when the market comes to its senses. It doesn't feel like a victory lap. It feels awkward, and people accepting their personal limitations and the market's limitations and coming to terms with reality. Sellers are still anchored to old prices. Buyers still traumatized by rates or losses or risk or prices falling. They're not, they're scared of more downside more than they're like, this is a huge discount. Nobody's like, houses are 20% off by comparison to the peak. They're like, we just saw them fall 20%. They could still fall 20%. We've learned what's possible. Lenders are conservative, which obviously the OSFI thing I think is going to play a bit of a role in changing. Everyone's staring at listings that have been sitting on the market for 40, 50, 60 days. Is this a deal, or am I at risk of catching this before there's another down leg? And this is like, it's a falling knife contest, right? Nobody wants to be the first person to stick their hand out and start the knife catching competition.
Yeah. Yeah. I mean, you're so right. But, the funny thing is RBC also points to the affordability trade-offs that are becoming pretty obvious, right? Buyers are delaying purchases, cutting vacations, changing spending habits. And some are considering using like retirement savings or HELOCs or money that, maybe should stay where it is to buy stuff. And the last one is definitely a warning signal.
That actually, I think we did an episode when StatCan put this out on the like rates of debt. Like, household indebtedness is going down for younger generations because they're not buying houses, they're renting, and they're not taking on big mortgages. But household indebtedness for older generations, baby boomers and Gen X, is actually rising, like, for the first time in their adult financial lives since they were kids first taking on their mortgages. And so this is the eerie part, is you're starting to see, what you just described, people making these compromises on, I have to lever up, and maybe I'm going to have to start watering down my kids' inheritance just to be able for me to afford retirement or whatever that I thought. What is it? The reverse mortgages at an all-time high. And so lots of factors going on. And I think when you see that, when a household starts rating their future security to buy the present shelter or borrowing against their kids' inheritance to help their kids buy a house even, I don't call that an affordability recovery. I mean, Desjardins just put out a report. I'll pull it up actually, because they put this out. This is one of my favorite things, but that Canadian household debt just climbed again. So it was at 177 on the last reading, and then this quarter it's 180. So we peaked at 188 in the pandemic, and then it dropped. I'm like, this is great. Canadians are finally deleveraging. And then we just like, well, no, we're going to stop there, and just started climbing back.
Gotcha.
I'll pull the chart. I'll pull the chart up when you're chatting next. But, the system is requiring people to over-adapt just to be able to participate in the housing market. And this is where I think, as real estate investors, you need to separate what is buyer demand and what is buyer strength. there's demand. Canadians still want home ownership, but strength, like the market actually being strong, means they have the income to buy the houses, and they have the cash reserves, and they can qualify for the mortgages, and they have debt service capacity and the margin of safety. And we're not just creating, this like unsafe, volatile market where you're just going to repeat the same mistakes. A buyer who can barely close is not the same thing as a buyer who can absorb an economic shock. And I think the buyers who can barely close aren't necessarily being buyers who are like, they're not willing to, they're being self-aware. They're saying, this is too high risk of an environment for me to make this like very, very tight margin decision. It feels like, I think, right?
I mean, I think it's hard to paint this market with a broad stroke, but I think within that broad stroke, there are several different strokes, and that's definitely one of them. Definitely a lot of people feeling that. Now let's talk about people feeling losses, Dan. And, usual suspect, of course, Ontario, GTA, crazy losses that we're seeing. At first it was house porn. Now it's like house loss porn. It's terrible. I don't love to see it. I mean, like, you're essentially, there's almost like a little bit of a celebration going on with people losing hundreds of thousands of dollars, which I do understand, they deserve it, or, they made the mistake, those idiots overpaid. But guys, this is people's livelihoods. This is hundreds of thousands of dollars. Some really nasty comments and stuff going on out there. So just remember, when you see a photo of someone that has taken a heavy loss in a house, there are some very real life repercussions.
I think
talk to me about what Terranet's putting out here.
Yeah, I will. I think cheering it on is like a little like weird. It's like, nobody deserved to be like told during the bull run, like, have fun staying poor, like you're going to rent forever, when they couldn't afford houses and said, I don't want to do this. Right. Like, nobody was saying that was correct for the bulls to say that to the people who were, fearful of the market. But similarly, like, two wrongs don't make a right. Don't go and do what they did now that you're the one who's in the, the morally superior position or intellectually superior position. It's like, it's just so silly, like how quickly people just flip their behavior to do exactly what they criticized the bulls for doing to them. So anyway, I think, you're talking about the losses. The one thing I will mention on this Desjardins report that I found interesting is their headline says rising household wealth is driven by financial and real estate gains, which we can talk a little bit about in another episode. I think I have a whole episode on this, but the household indebtedness piece is that it worsened to 180, which kind of leans into what you were saying about, the people being fearful to jump in. Okay, if my debt load's crazy, I'm not going to want to jump into the market right now. But if I look at Ontario, this is sort of we've always used Ontario as like less us trying to be Tony Toronto's or like center of the universe or whatever, and more what happens in Ontario is often indicative of what could happen in other places. And every other market we talked about the tale of two markets in our CREA episode. Every other market in Canada is hitting all-time highs, or at least up from the rate hiking cycle. Ontario and BC are the only ones that are down. And Terranet's Q1 2026 market insight report looks at Ontario's market using all the land registry data. And so this isn't just realtor listing sentiment, it's like actual closing transfer activity. And the headline is that Ontario didn't and has not at all had a rebound or anything. Seeing a bit of a rearrangement on buyer type, property type, and geography.
Yeah, I mean, really interesting data. And I love the not recovery, but rearrangement. That's another great way of saying something without really saying it. I mean, it's obviously better than saying there's a big crash or there is a recovery, right? Some things are weaker, some things are more resilient, and ownership types and makeups and all that kind of stuff are changing.
Yeah. And Ontario condo transactions declined 3% year over year. In 2025, Toronto condo transactions dropped about 8%. New build transaction volume also declined 12%, even though we're supposed to have record closings in that year. So a lot of failed closings probably showing up there, while resale activity was down about 2%. So the pain isn't like evenly distributed across across everything. It is more concentrated in condos and in new builds, which is like, logical, but it's always nice to see it represented in data. And a lot of this pandemic era investor product where you're seeing those pre-cons, but also the people who bought in 2022 selling at losses too.
Yeah, I mean, look, then speaking of selling at losses, right? Let's get to the power of sales stuff. And Dan, we've been covering power of sales for years now, as they kind of have seen an uptick recently. So if you're interested in learning more about that, just type power of sale into whatever platform you're listening to us on, and a whole bunch of stuff with power of sale, and the title will come up from us. Look, they've increased from just over 2,100 in 2024 to almost 3,000 in 2025. And that's the most recent data we have. It's still obviously a very small share of total market activity, but it's the direction that it's going and the pace at which it's going that matters and that is a bit concerning at this point.
Yeah, exactly. I think, especially if you're thinking, okay, could this translate over to Canadian, like other markets across the country? We've covered this on the Realist website, where I basically post all of our newsletters and reports now. Bank of Canada put out the mortgage delinquency early warning signs, which we did an episode on. Equifax Consumer Trends reports points to the same thing. And we have that motivated sellers report and motivated sellers tool where you can actually see power of sale listings from across Canada on the realist.ca website. So make sure you go check that out. While I just figured I'd toss that in there because I know our audience is Canadian. It's not just Ontario, although that's the largest group. And so we wanted to make these tools so it's possible for you to, if you want to go look, see what deals are offering vendor take back, see what deals are power of sale or foreclosure, you can do that on realist.ca now. But the absolute level stays kind of like, okay, this isn't US foreclosure crisis, right? Our banking system is different in the way that we take possession of properties. You don't get that downward velocity that happens in the same way. The rate of change that we're seeing, though, like that increase is telling me, don't ignore this. Stress is building or it's materializing. And that's usually how these, the cycles finalize. This is where things start to show up on the edge first. Variable rate borrowers, forced sellers, people resetting mortgages who are kind of slowly running out of room, your peak pandemic buyers, investors with negative carry. And then you start to see the good deals start to happen. And we've talked about this
Yeah.
since we started the show. We started the show basically right coming off of the hottest market in the country, or in Canadian history, right? And now we're getting into the worst correction in Canadian history. And we said, well, usually what happens when you start to see that rollover is everything that's kind of been happening. You don't have to pull the trigger right away. But every day that goes by, as prices grind down, better deals start to appear. And when is that buying window going to actually happen before things start to recover? The big one I think that we're and you're going to go through it a little bit is the loss data. How many people are selling at a loss, and they have a cool matrix on that. But people who assume they could refi, out of a private into a A or B, or their property was going to go up in value or whatever, or they could sell into a rising market, they're running into some challenges now.
Yeah, I mean, look, the lost data hurts, but it is so key, right? And what you're looking at right now, Dan, Terranet and the good people over there put together this great information on Ontario properties that were purchased between 2022, so purchased about 4 years ago now, and then resold last year, and almost 37% of those properties sold at a loss. And I would suspect that number is probably, unfortunately, rising right now. We just, of course, can't collect the data that quickly. Just finishing Q2 here in Canada. This hurts to see. I've had to be a part of some of these transactions. I've had to advise people to do this. This is, there's a couple different reasons to do this. Usually it involves two things: finances and stress. And one of those breaks and people just want out, even irrationally, or they want nothing to do with real estate anymore, or unfortunately they are forced in one way or another to sell and take a loss, whether that loss be $10,000, which is still frustrating if you own a property for 3-4 years and you lose 10 grand plus maybe all the costs associated with selling, or you're losing hundreds of thousands of dollars, which again, you really shouldn't be wishing that on anybody. It's tough enough out there already.
Yeah. And I think, to be clear on this, the data doesn't mean that 36.6% of all Ontario homes sold at a loss. It just means that homes bought near the peak and sold 3 years later had a very high loss rate. And those are the people who, if you're selling to absorb that loss, you kind of probably need to. You can't hold on anymore or whatever. And this is exactly where you would expect to see the pain: is these short-term holds, buying into volatility, exiting into interest rate volatility, bad entry point, higher carrying costs, weaker resale market. Typical, like very common cycle story. 36% of the properties that were bought in 2022 and sold in 2025 in Ontario are sold at a loss. This is a high number. And I think
Crazy.
this is where you start to see like decent opportunities for investors. One man's trash is another man's treasure, I guess. I don't know. There's like a counterparty that can buy these. Yeah.
100% for every, and I don't use this term, loser lightly, but for every financial loser, there will be a financial winner here, right? So, I mean, look, Peel region had the highest GTA rate for that cohort, unfortunately, almost 30% up in 22% from 2024. Cottage country, whoo, damn, we did an episode recently on cottages and what's going on in that market. And man, did that thing full send on both audio and of course on our YouTube. So go check out our YouTube if you didn't know that we record stuff over there. You can see some of the charts that we're referencing. But yeah, it's kind of like that pandemic map is reversing a little bit, right? Places with the biggest spikes are now experiencing losses, and the places with mediocre spikes are experiencing mediocre losses. The places that sold extremely high are now taking big losses. Let's keep this party going, Dan. Let's move on to another segment here. This one is first time buyers. Okay.
Yeah.
They're back. First time buyers are back, baby, but a little different. They are older. First time buyers have become the largest buyer segment in Ontario as of last year, 2025. And that sounds overall positive, doesn't it?
Yeah, it is positive in one sense because, they are the biggest buyers in Canadian real estate. It should be good that people are, being able to realize the Canadian dream of homeownership. We've heard a lot of this, like wealth building, blah, blah, blah. But it also shows, I think, how strained the market has become because investors and I think that first time homebuyers are older as well. So they're getting, and we'll talk a little bit about that, but also shows that multi property owners fell from the top spot. So your investors are
Interesting.
basically, yeah. So your investors were one of the biggest buyers in the Ontario market. First time home buyers became the largest buyer segment in 2025, and multi property owners fell from the top spot they held during the investment peak. First time buyers stepped forward as prices softened and affordability improved a little bit. So the first time buyer is back, but they're not the same person that they were a decade ago. Terranet says the average age of a first time home buyer in 2025 was 40 years old, Nick. 40.
And
Crazy.
wow. Yeah. Like it's funny because listen, as a guy who's approaching 40, I don't feel like it's that old. But if you are 20 years old, you are looking and thinking about 40, like, that's an old man or woman right there. Look, 40 doesn't really, I feel like most people would agree with this. 40 isn't exactly like starter home, first time home buyer. It doesn't really have that overall energy to it, right? Like,
Yeah, it's definitely a different energy, and I think the language has not really caught up to the math. Although I don't really know what you would call it if it changes to being a different type of first time buyer because they're still a first time buyer. But you usually think first time buyer like young couple out of university. They're taking the next step in their relationship, doing household formation, and buying a house together. But now your modern first time home buyer is somebody who's rented for a long time. They're mid career, dual income, supported by their family, maybe, pulling some equity, and they're still stretching. This is Ontario, but
yeah.
this is Terranet says nearly 3/4 of non-condo first-time purchases involve two parties, and close to 19% involve three or more parties. So that's mom and dad co-signing or whatever it is.
Wow.
Which we've talked a lot about the data on that. But what this matters to investors because these are who you're competing against, or who maybe you're renting houses to, or whatever. Affordability is forcing people to pool their balance sheets, and this is where multiplex has been so fascinating to me. A lot of the people who come to our multiplex events, which by the way, Toronto, September 15th, huge venue, one of the coolest venues we've ever seen.
Yeah. Very
Make sure you
excited.
get your tickets to come to this. Early birds are going very quickly. And, I always get the inevitable message from the couple of people who are like, oh, the early birds, can I get one still? No, like it says they're sold out. No, like that's
They
the
are sold
point of
out.
it. It's like, yeah. So like, for
And
those
this
of you who
event
are
will
listening,
sell
who are
out.
one of those people who sends me these messages, please just go get your early bird ticket. I've already reminded you like 50 times on the show, 50 times on Instagram. Don't make it hard for us to have to market these events and keep reminding you if it annoys you on the show. Just buy the tickets if you're going to come to the event. Okay. It's going to be an awesome one anyway. But this is one of the trends that I'm seeing in the multiplex space. We see so many people coming to these events who are looking to build a duplex or like a little, two unit semi detached on a property together because they can't afford to own a house on their own. And so affordability is actually forcing people to pool balance sheets on asset class as well and getting into the multiplex space.
Yeah, man. So it's like, okay, first time home buyers are back. Well, that's great. But how are they back? On what terms? I mean, Canadian housing hasn't solved the affordability problem. It's basically taught households to bring more people together, have more years of savings, have more family help, sacrifice more on the same purchase you would have 10 years ago. So difficult stuff, Dan. Let's move on to our next segment here. OSFI released some of the bank capital before the BC condo fight. Of course, there's one more story. We're going to talk about price discovery. And Dan, we've already done a two-parter on the condo bailout. So let's keep that one out of this episode because I feel like that's going to deserve a whole nother episode. That'll just kind of be like an ongoing story that we cover here.
They seem to have they seem to have calmed it. They've sort of calmed the storm, and I haven't heard much about it. And so,
yeah, I'm looking forward to episode 3 with that, which will probably be a little bit more chill than the first 2, which were a little.
It depends how they play it out. Like if they, I feel like if they, I mean, if they,
it's not us. We're just the simple voices that report on it. But
I think they just stopped trying to walk it back. They're like, look, we're just going to let this blow over and then we're going to quietly do the deals and it's going to get leaked and it'll probably become a storm again. But, until I think that they realize that this is a very touchy subject.
Yeah, no shit. Aussie lowered the domestic stability buffer for Canada's largest banks from 3.5% to 3%. Doesn't sound like a big deal, but we're talking about hundreds of millions, billions of dollars here. 50 basis points is a lot of money.
I think it's like trillions of dollars. I mean, that are
trillions. Yeah, sorry. Wow, of course. Look at what a peasant I am.
Across
thinking
all the banks,
billions.
Yeah. I know. Yeah, geez, you need to be in the 4 comma club, man. Come on. I think that this is a very interesting move, and I'm weary to decode it because I don't know. Like, I think that, let me explain it first, and then I'm curious to hear your take because I know you work with banks all the time. Like, are they less eager to lend? Are they scared? Is OSFI trying to kind of push them a little bit to be willing to take more risk? So the domestic stability buffer is basically a capital cushion for the big banks. It's common equity against risk-weighted assets. So if OSFI lowers it, the message is you just built capital during the good times, and you can see this. Go look at the stock market. If you listen to our podfathers, Simone and Dan Kent, Canadian banks are ripping. They're hitting all-time highs. Okay,
crazy,
massively outperforming the TSX and even the S&P. So they're doing okay. Like, it's safe to say we probably are not at risk of a banking crisis in Canada. I know some people feel differently. I just don't think that that's the case. And so let's go with that. OSFI is correct here. That when they lower it, the message is you just built all this money during the good times. Like use some of it to help us fix Canada's economy as the economy adjusts.
Sounds fair and reasonable to me.
Yeah. Like some of the big banks were before the government had to step in and do the bailout. Some of the big banks were basically doing a private sector bailout anyways with blanket appraisals.
Yeah, exactly.
And then OSFI kind of said, hey, maybe you shouldn't do that because it's technically you're going over 100% loan to value, and that's not fair to the rest of the market who can't go get 120 LTV loans because they levered up on a pre-con, right? And so, hey, we'll give you some different tools to do a private sector bailout.
Creative financing, dude. It's a beautiful thing. I mean, look, the big banks, as you said, they've remained extremely resilient, extremely profitable, very well capitalized. They have an average CET1 ratio of about 13.5% in recent quarters. So there's this is not an emergency cut. It's kind of more of a controlled release. The goal is to avoid capital rules becoming pro-cyclical, right? You can't just change the rules every time the wave changes kind of thing. You do not want the banks pulling back too aggressively when the old mortgage risk, weaker collateral, unemployment, and stress start showing up. Canada's got to roll through the waves because of the 5-year mortgage term. Right, borrowers again took that low rate back 4, 5, 6 years ago, 21 and 2020. They didn't really hit the wall all at once. The pain has shown up and been spread over the last couple of years, and we've been covering that day, and we're in the midst of it right now. So it's not that the banks need a rescue. I think the banks are doing just fine. It is though. Do not let the rules force banks to make this downturn worse, which they very much could, right?
And I think this really ties back to everything else we've talked about in the episode and what we're going to talk about in one of the last segments here. Households are stretched. Sellers are taking losses. Developers have unsold inventory. We've belabored that point. We've beat that dead horse to, I don't think we need to continue covering what's going on, but everybody's heard about this bailout thing. And I still think it's too early to call whether or not it's a good thing or a bad thing because we don't know the details. But banks are watching renewals. They're changing their loan loss provisions. They shored up a bunch and then they've kind of reduced them a little bit since. The government's debating whether or not they want to step in and do this condo absorption thing. Every institution is asking the same question, which we talked about at the beginning of the episode. How much price discovery can we tolerate before it becomes a stability problem? Because we've already seen the biggest drop in Canadian house prices in history. And I don't care if people are like, oh, 2022 February wasn't credible. It was too frothy. It was literally the highest volume sales month ever in Canadian history. So I get it. Like if it was a low volume pump, like it's some penny stock where like nobody's buying it and it shoots up to the moon and they can't exit because nobody's buying. This was the most liquid market we've ever seen. It was a highly credible, real peak. Lots of people piled into it to pay those stupid prices. Yes, do I agree that they're stupid? Yes. Do I think that we should reset the peak number to a lower baseline to make it seem like house prices haven't fallen that much? No. House prices have fallen significantly, the largest drop ever, minus 28% from peak of February 2022 to present day. So all of these institutions are asking, like, can they floor the market? I don't know. Is it visible that they're actively having a discussion and kind of like positioning and moving the guys around the map on the war room to figure out how and when to do it? You can kind of see it taking place, I think, a little bit now.
For sure. And I mean, look, this is unfortunately something that the average Canadian just can't really do anything about. And, speaking of the,
other than like pay as much attention to it like this, like what we're doing, analyze it as much as you can.
And kind of figure out your own personal economy, right? And how this is affecting your own personal economy. Now, speaking of the average Canadian, well, this is where things get even more interesting because the average Canadian, aka the population of this country, that story can change the demand side of this whole thing, right? Again, you've heard me say it on the show before, on this episode before, Canada's population fell, and again, for the third time in a row in the first quarter of 2026. That is the third consecutive quarter where Canada's population has declined. This is not good.
Yeah. A huge shift for investors. Population growth was the easy bull case for everybody to use for years. The biggest places I saw it taking place, student rentals, one massive portion of the student rental or student population, people renting those were international students. And that number is being scaled back massively. And then medium-term rentals as well. Like a lot of people who got, bought for Airbnb and then got hit by the rules and then shifted to medium term. And they were maybe housing somebody who was new to Canada that was between, just getting here and trying to shop neighborhoods and maybe buy a house or rent a house or whatever, find a long-term rental. Canada was adding people faster than it was adding housing. International students, temporary workers, permanent residents. We had low vacancy, the lowest vacancies we've ever seen. We had not enough construction. And, the lazy thesis that the real estate industry kept leaning on was everyone needs a place to live. And honestly, that worked for a really long time.
And it's true, right? It worked because it was true. But if your thesis relies on completely variables they have completely no control over, like, is the government going to keep letting, 1 million people in a year? You need to reevaluate your thesis. But at that point, right, supported rents, pre-construction, small city market, student housing, the idea that demand would eventually bail at today's bad performer really did exist. And, the music stopped and it hasn't.
Yeah. And if population growth was the tailwind, falling population is not just a smaller version of the tailwind. Like it's falling. It's not like population is still growing, but it's smaller. It's going down. Population is dropping. Okay. Third consecutive quarter. In some markets, huge headwind. First place I would watch, as I mentioned, student rentals. The decline is driven by fewer non-permanent residents, especially fewer international students and temporary foreign workers. Then your student-heavy markets feel it first.
Yeah, I mean, 100%. The student rental investor did so well for a while. Crazy.
That was the only way to cash flow during the pandemic before MLI came out. Was like the only way.
Well, I mean, we'd go and see some of these places, right? You'd see a big old Victorian home that might have been a duplex, and people were converting them back into single-family homes with just putting up bedrooms everywhere they could, right? You'd go and be like, well, this wall looks like it was put in like yesterday. And in some cases it was. And that was because, in student rentals, you rent on a per bedroom rent, not a per unit rent. So it's not normal household, not normal household formulation. And that per bedroom rent works perfectly when demand is deep and you've literally got people lining up for bedrooms. But of course, again, it gets really fragile when the tenant pool really thins out and you've got a whole bunch of bedrooms to fill and, groups aren't coming like they used to, or the, 1 or 2 students at a time aren't coming. So look, vacancy doesn't need to explode, but 1 extra month vacant, 2 extra months vacant, 1 or 2 bedrooms that don't get filled, that can really change the math on some of these properties. And of course, the secondary market investor and the condo investor, these were all theses based off of this endless population growth. It's so funny because humans, when we see something happening, we're like, I don't people are just like, oh, this is just how the way it's going to be. Like there's just always going to be a ton of immigration. The population is definitely going to grow. But that's not the case here, Dan. It's not the case in some European countries. We're seeing population decline in a lot of the, a lot of like the Western world here. And it's having significant impacts on real estate and the silver tsunami, which we've talked about, and all of these other interconnected pieces of the economy. So anything else to add there?
No, I don't think so. I think it's a good place to wrap it. I know we're pretty much at the end here. We don't really need to go through the condo stuff. I was going to do a deal of the day and an audience question, but maybe we'll just actually I guess we got
let's do the audience question.
Okay, yeah. So
we haven't done one of these in a while.
I have. So if you're in the we used to do these a ton, and then I don't know, we just kind of stopped doing it. I think there's just too much news. So on the audience question side of things, it was basically like, if rents are falling, I got to find it here. I had it in the script, and it's but basically,
if prices are falling in parts of Ontario, should I wait or should I start making offers? Dan, over to you.
Look, I think it's both. So you go back to what I said earlier in the episode. It's always a good time to do a good deal, always a bad time to do a bad deal. Start making offers. If you're concerned that prices are going to continue falling, price that into your offers. And I know realtors are going to roll their eyes when they hear this. And I'm a realtor too. And I have clients who come to me and they're like, I want to lowball everything at 10% under asking. And I'm not, okay, cool. Like eventually you'll probably get one. But in the meantime, you're going to have to deal with a bunch of headaches. So don't get mad at me if people don't want to look at your offers. I'm just going to verbally make the offer to them, and we're going to say whether or not it's worth papering. And if they say no, then don't tell me that I need to go and draft it and present it and whatever. Don't waste your professionals' time, et cetera. If they've already communicated to you that they don't want to see the offer. But if you're fearful that prices are going to drop another 5% or 10%, let's say 10%, and you assume that the property that you're offering on is listed at market value, and that will eventually sell at that price. If you can get that property at 10% below what it's listed at, you captured the future value. Should I have waited in that situation? Well, it depends. If the house was my primary residence and I didn't have any other costs, my parents were giving me free rent or whatever. No, you probably, the net effect of you waiting could have been better. Maybe you get a better deal later. But if I'm, saving myself rent, if it's my primary, or if I'm an investor and I'm going to earn a yield during that period of time, or I'm going to go through my development process so I can be ready for the construction season during that period of time, there is an intrinsic benefit to owning real estate longer. Like, it's a yielding asset. It pays you money. So the longer that you own it, the better of an investment it is. Every mortgage payment that goes by, you pay less interest and more principal. And so it becomes more efficient at paying itself down. So I would always bias towards own it sooner rather than later, if you can get it at a good price, if you can do a good deal. Yeah. If you're fearful of downside risk, price in the downside risk.
I'm going to say something super annoying, but it deserves to be said in this episode. It is always time in the market versus timing the market. Even if you are one of those 36% of Canadian geniuses that know when to time the market, Dan, you're right. Pick your market, know your rents, know your replacement costs, know your comps, know your financing.
It can only be it's only time in the market if your deal doesn't suck, though, right? Like if your deal sucks, I can't fix that problem for you. So just don't buy bad deals. Like if the deal sucks, have a pro forma, have very specific parameters on what you're trying to buy. Don't deviate from them. Stop changing stuff in your model. Like the deal would just work if I did this. It's well, that tells me the deal doesn't work. It's like relationships. That's the easiest parallel for me to draw. People are like, oh, well, we'll stay together if we just do these. It's if that's what it's a hell yes or no. That's it.
I agree more.
Yeah. So that's my answer to the audience question. Good. And if you want to leave us an audience question,
please do so.
Well, So give us some reviews. Leave us a review with a question. You can do comments on Spotify now too. So comment on the episode with a question. We check all those now, and we're going to keep doing that. We'll do the deal of the day segment, but I think we ran out of time. But go to realist.ca and just email us a deal or whatever. Email us the link on the realist site, and we'll run your deal on the show. And we're going to I'm going to try and sneak those in almost every episode, probably at the end.
I love it.
Maybe the odd time at the beginning, but anyway.
I think that. Well, look, we've got thousands of deals being underwritten, so definitely some stuff to talk about. Go check out realist.ca. Come do one of our amazing events across the country, and if you got any ideas for a show, You want Dan and I to talk about something specific? Let us know. We're here to help.
Yeah. And
That's it.
Multiplex Toronto, September 15th. Early bird tickets will probably be gone like by the next episode after this one comes out. So just get your early bird tickets. Don't ask me afterwards. I'm going to put a reverse coupon code for anybody who asks me after if there's early birds. You can pay a 25%
$20
extra for not listening to me and just getting the freaking tickets. Sorry. It's good business. Like we reward people who do good business practices. We want you to be able to, it supports us by showing that we can have enough tickets. So, that's what we get from it. That's why we give you the discount. If you want the discount, just do it.
There you go. Love it. Get your tickets. We'll see you then. Thanks so much for listening.